Let me go ahead and I'll get the PowerPoint showing up on the screen.
Thank you, Ivory.
Yeah, of course. Maybe. Okay, there we go. I think this is what the way I need to do it. Let's see.
I can see it. Yep.
Oh, no, that's the wrong way. Hold on. Let's try it this way. Why is it showing everything on the wrong screens? Okay, hold on. I gotta stop sharing.
That looked right there.
It's not showing you the.
It was in presentation mode.
Yeah, that's the part I didn't want to show. I'm gonna try this a different way. Okay, let's see what happens now. Do you see presentation mode or, oh, yeah, presentation mode again. Why is it doing that?
I think if you do it as a slideshow and it shows up in presentation mode, there should be 3 dots that you can click. Yeah, right there, underneath the image. The 3 dots, and then you can undo the presentation mode. There you go.
Well, hold on. I like presentation mode because I want to see what slide's next.
But you can do it where you can see it, but they can't.
Right, I know. That's what I'm trying to change.
I right click on that screen.
So in Zoom, if you open it in editor mode and share it in editor mode, and then I'm trying to remember the trick to it. And then you do the three dots to hide it in editor or hide the presentation mode while it's in Zoom. You can still see the presenter mode, but we can't.
This should work.
There we go.
Yeah, okay.
There you go.
I just used the other monitor. I still didn't figure out the right way, but hey, we're working. Okay. Well, thank you for bearing with me through the technical difficulties. So today we're going to be talking about mastering client credit. I'm going to just go into who I am and then we'll jump right into everything. So my name's Ivory Becker. I own Incite Strategies. We are a credit solutions company. Best way to put it is we help people with improving their credit scores. I also co-founded a software called Credit Score Pro AI. And then we have a credit education course. So called Credit Worthy. So everything we're focused on is about educating both consumers and professionals on the inner workings of credit with the goal of getting more people approved for mortgages. I kind of talked about this. Our mission is really based around financial literacy and credit worthiness for all. Whether we're a professional or a consumer, we really just aren't taught about credit and how credit works. So we are going to look at the structure of the credit profile, a lot of myths and misconceptions that your clients are hearing about credit management. And then we're going to do a brief dive into collections simply because of what's going on in the climate right now. It'll make more sense as I get into that piece. And then just some overall tips. That slide's in there twice. Has anyone here been to any of my presentations before? Well, except for you, Crystal and Chris. Because this trivia is not going to be new to either of you guys, but we'll jump into it for everyone else. So 19 million adults lack a credit score, and 37% of adults have a credit score below 700, which is more than most people expect when they see that number. And then 16% of adults have a credit score below 579, so below that 580 minimum score threshold. And just for fun, what state do you think has the lowest credit score? Lowest average credit score? No guesses? Okay, fine. I'll just tell you. It's more fun if you guess. All right. So Mississippi is the state with the lowest credit score. And I have too many transitions here. I couldn't figure out how to undo them, so we'll live with that. And 22% of adults have a score of 800 plus, which is a fair amount. And 1.2% keep that maintaining of the score of the 850, that perfect credit score. And the score with the state with the highest credit score is Minnesota. So I just went and told you since no one wanted to guess on the first one. Okay. Now, we know the major problem is there's no life lesson on credit and home buying. And our clients are coming to you as mortgage loan officers as the solution. When they don't have a strong understanding of financial literacy overall, they expect you to be their advocate and help them create opportunity, right? And with their overall goal of being a homeowner. And statistically, households who are homeowners have 40 times more wealth than households who rent. This is a fun statistic to share with clients. So in the last 33 years, the median average wealth increased by almost 165,000, and since 1989 by 900,000 for homeowners. For renters, respectively, it was 5,800 and 56,000. So big difference between those who rent versus own a home. Oh, I'm sorry, I didn't see your question. Is there a reason for states with the highest and lowest scores? We're not necessarily given a reason from the statistics. I think in general, we have a massive issue with financial literacy overall. Some of it has to do with income levels and poverty. Often in states with higher poverty levels, we see lower levels of financial literacy and in turn lower credit scores. But yeah, Minnesota does have a lot of retirees. So, and feel free to unmute yourself, ask questions. I do want to make sure you're getting as much as possible through today. So if we need to deviate from what I've prepared, that's absolutely fine. So consumer behavior is changing. Younger borrowers, of course, are looking very different from prior generations. Everything's more expensive for these younger borrowers, and the income is not keeping pace with the cost of everything, including housing. The other thing we really need to consider is how delinquency levels were very much abnormally low during the pandemic. A lot of the government relief programs, were suppressing negative data when it comes to delinquency rates and really keeping people afloat for a long period of time. And now we're starting to see a lot of things bubbling under the surface. And a lot of that has to do with debt to income ratios and credit both. So let's take a look at that. This is what an average pipeline looked like in 2020. Unfortunately, I haven't been able to gather this data since 2020, but this next slide is going to do a nice comparison. So there's about 70,000 people that inquire about a mortgage. They're just asking you as loan officers about mortgages, not necessarily submitting applications. Again, this is back in 2020. We saw about 46,000 of those individuals submit an application, and then only about 25,000 close. So only about 35% of people who inquire about getting a mortgage actually close on that mortgage, and it's a lot of fallout. Now, when we narrow things down and we look at, okay, what is causing some of the fallout from application stage to closing, we see the biggest denial reasons coming from two things: debt to income ratios and credit. So if we look at the data and we look back from 2021 through 2024, we saw 34% of loans denied in 2022 for DTI, which was up from 30% in 2021. And then in 2023, 39%, and a tiny little dip in 2024 of 37%. All that to say, we're seeing DTI becoming an increasing issue when it comes to declines. And if we combine that, if we look at DTI and credit combined in 2020, 53% of declines were debt to income and credit combined. Now, if we look, and this is the image of 2020 here on the right of the denials, but now we're up to 59% as of 2024 data. We're still in 2025 now, so we'll get that data soon as we close out the year. But as of 2024, 59% of declines were tied to both debt to income ratio and credit. So it's becoming a bigger reason we're seeing people not be approved. But there's a lot we can do about it, and that's really why we're here today. And I just wanted to show you this data to really set the stage of what we're going to be discussing and what you can do about it, so we can bring that number down. Okay, so getting into a little bit more of what we're seeing on a consumer basis, I'm going to start diving into some other statistics, and then we're going to go into the credit report side of things. For the purposes of this discussion, I am pulling data from Vantage rather than FICO, which you guys probably know you're using FICO credit scores to qualify borrowers. FICO will not give us consumer data. It's very, very frustrating. So we do have to lean on the Vantage score to give us some of this consumer data, which is still very helpful to draw conclusions with FICO scores. So the way Vantage breaks down score tiers, we've got those borrowers those consumers, subprime in scores of 300 to 600, near prime 601 to 660, prime 661 to 780, and super prime 781 to 850 for scores. So what is happening with consumers in these different buckets of credit scores or these different tiers? We're seeing this divergence. So the people that are in that super prime category, the super awesome credit scores, they are maintaining strong scores, but we're seeing a big increase in delinquencies. And the people that are in that prime, that score range of 661 to 780, we're seeing them slip the fastest when it comes to delinquency and scores. So we're seeing a lot of people drop down from prime scores into the near prime and even the subprime categories. And those in subprime are kind of staying put. We're not necessarily seeing this massive increase in delinquencies, but we're not really seeing them recover from those lower credit score ranges. What do I want to talk about next? Sorry, I'm going to skip through some of this just because this presentation is designed to be longer than what we have for today. But I like this slide here. So I just think sometimes visuals are helpful. So this graph is looking from 2020. Here, let me grab the pointer here. This graph is looking at 2020 through September of 2025. So we have some fairly recent data in this chart. And I think what's helpful to look at here is this breakdown. So we're looking at delinquencies. The blue is 30 to 59 days past due. Orange is 60 to 89 days past due. And 90 to 120 days past due is this teal color. And this is looking at all types of credit. So it's not specific to any particular credit type. What is important to note is the rise in delinquency levels. Specifically, we're seeing a bigger jump in delinquencies from the 30 to 59 days past due, even more so than what we saw back here during the pandemic. This rise in delinquencies also is something that we're seeing more on our end, have to do quite a bit with student loans. And we'll look at that on this next slide as well. So how many of you are seeing more student loan delinquencies when you're getting applications right now? Is that coming across anyone's desk currently? No, yes?
Yeah, I've seen a few.
Okay. So there's a lot of confusion for consumers out there regarding their student loans. We, of course, had the forbearances that were put in during COVID and then continuous extensions on those student loan forbearances. And then we have different programs, different payment programs that people are enrolled in. The SAVE program is still in forbearance because it's tied up in litigation currently. And it's the only program still actively in forbearance. What happened was as of September 2024, people had to start paying their student loans again. They were sent notices, but the problem was the forbearance was for so long that a lot of the email addresses, mailing addresses had changed for a lot of people. So they weren't necessarily seeing the notices that their student loans were going to be due again. And unfortunately, because student loans are promissory notes, that's not a valid reason to try to get delinquency off of their credit report. not getting that notice. So we ended up seeing 4 million direct loan borrowers and 2.8 million FFEL borrowers in default. And now we're seeing those rates increase even more because people are not necessarily on top of the fact that their loans aren't being paid until they get their credit pulled. And now all of a sudden they're aware that they're getting delinquency. Now, another thing to be aware of is student loan servicers don't report delinquency until 90 days past due. So by the time it pops up on someone's credit report, it's already a severe delinquency. So jumping into the credit side of things, now we're going to talk about what do we do about these problems that we're seeing? What do we do about the increase in delinquency, and how do we get those scores from poor or fair or even good into the very good or the excellent category? So I'm just going to set the foundation. I'm sure most of you are understanding the basics, so I'll be very brief. The credit score is a tool that's not made for the consumer, right? It is made for the banks, the creditors. It's for them to assess risk. It's a risk tolerance tool. And a lot of consumers don't quite understand the relationship between the credit bureaus and FICO, as well as the furnishers, the data furnishers, the creditors and the debt collectors. So I think something to make sure everyone's aware of is those creditors and those debt collectors, they're furnishers. They pay Equifax, Experian, and TransUnion to report information. And then similarly, the creditors pay them again to obtain the credit reports. Why that's important as a consumer is because they're not necessarily caring so much about data integrity as much as they really should. At the end of the day, the bureaus want to make money. The bureaus also don't own the credit score algorithm, right? FICO, or Fair Isaac Corporation, FICO owns the algorithm. They allow the bureaus to use that algorithm. So the bureaus don't really control the mechanism for how the scores themselves are generated. They just use the score. What we tend to see is a lot of errors on credit reports because the bureau's sole purpose and goal is profitability, right? They're not incentivized to correct errors or to make sure that data is clean, which means there's a lot of people missing out on potential positive payment history that's just missing from their reports. We see a lot of no data showing up for positive payment history, but also errors on negative history on their credit reports. And then there's this foundational understanding of how does the score itself get calculated. Most people have pretty strong misconceptions, and I want to go through what some of those misconceptions your clients have are. So we're going to start off with looking at the basics of the credit score. So payment history is 35% of the credit score. It's the biggest overall factor. What I think everybody here knows is that positive payment history helps. Who would have thought? And negative payment history, so missed payments, hurt the credit score. Now, where there's nuance in this category is a positive closed account no longer affects your credit. Your client's going to see those positive closed accounts on their credit report and assume that those are helping their credit scores, but they're not factored into their score anymore once they close them. Which means as they're getting ready to apply for a mortgage, a lot of times you will see clients pay off credit cards and close them, or pay off auto loans or other types of loans and close them. And what happens when they do that is they're not only losing that positive payment history, but they may be losing some of the diversity or that mix in their credit profile and that average age of open accounts. So that's often why clients will see this giant drop in credit score, thinking they've done something good and helpful, when in reality they haven't. Now, if we've talked about debt to income ratios being high and being an issue. So if there's a situation where a client, let's say they have, I don't know, $4,000 left on their auto, or even a couple grand, let's say $2,000 left on their auto loan, and they have the ability to pay it off and it help their DTI, help their approval, it's best to typically pay that as part of closing. So it's not affecting their credit score, but then you also don't have to calculate that into their debt to income ratio for qualifying them. Just just a tidbit of helpful advice. Another thing a lot of clients get confused is this amounts owed, also known as utilization category. This is very much focused on revolving debt. So credit cards, of course, and lines of credit. It's based on balance versus credit limit. And there's two calculations that help the credit scores here. The first calculation is each individual card. And it's all about ratios. So here's what I mean by that. You can have two credit cards on a client's report. Let's say one has a $500 limit and the other has a $5,000 limit. And they're both maxed out. They're both 100% utilized, right? They're affecting scores the same because it's about that utilization percentage. So you can see a bump in credit score from paying down the smaller card first. And it's just as much of a bump as you would see with the larger card for that individual calculation of each specific card, right? Because now the utilization 0%. It's helpful. The second calculation is based on the combined balances versus combined credit limit on the report. But if you're trying to help your client achieve some quick jumps in scores, and utilization is a big problem right now nationwide, we've got a lot of credit card debt going on. Tackling several small cards is going to create a nice boost very quickly versus having someone try to pay off one giant card or try to spread payments across several cards. You're going to see a bigger bump in scores just by focusing on multiple small cards, if that's possible for that individual's credit report specifically. The only time you're going to see this category be affected by a loan is in a situation where they owe more than the original balance on the loan. So the best example of that is going to be a student loan, where the interest is deferred, and then upon graduation and entering into repayment, they tack on that interest, and their $10,000 student loan is all of a sudden a $14,000 balance on a $10,000 loan. Then you're going to see an adverse impact to utilization just because they owe more than what the agreed upon loan amount was. Now, the only time I would ever suggest someone paying that down is if everything else looks perfect on their credit report. Then that can be helpful, but there's a lot of other things that are more impactful to address first. Anyone have any questions on any of that? I should pause there for a moment. Okay, we will move on then. Okay, I kind of mentioned this, but length of credit history is based only on open accounts. And then things like credit mix, you can impact those categories with different credit building and self-reporting tools nowadays. So if you have a client that has quite a limited credit profile, they have not a ton of history, then self-reporting rent, utilities, subscription services can be quite helpful. Now, in the current credit score algorithms that we're using right now in mortgage lending, which is this classic FICO here, you're not going to see much of an impact from that. It's going to be minimal. But as we start to transition into the new versions of the FICO scores in mortgage lending, those self-reporting tools are going to be quite a bit more impactful. Another thing that's really important to understand about this classic FICO model used in mortgage lending is when we look at payment history, if you have a client that has any missed payments, even a single 30-day delinquency, it can be worth a significant amount of points on this classic FICO score that you are using. And that's simply because this model is so old. Why that's important is because classic FICO was created in 1989, it's rigid and inflexible with its technology. The algorithm just doesn't function as well, to put it plainly. As time has gone by, FICO has created new credit score algorithms. That's why we have so many algorithms you see on this screen. We're all the way up to 10T now. This chart is a little out of date. So with these newer models, they've become more flexible in many different areas. But one of the main areas that we see really different from this old model is the time weighting of information. So if you have a client that has old negative history on these new models, they're going to have a higher credit score, much higher credit score, because it says, hey, that happened a long time ago. And what they're doing now, their behaviors now are very different than past behaviors. So they shouldn't be penalized as heavily. But your mortgage scores with classic FICO don't operate that same way. They look at old data similarly as new data. So even getting some old negative history off of a report can have a massive impact on their mortgage FICO score. And what creates a lot more confusion on top of it, we have all these different models I just showed you in the FICO score, but then now we have a Vantage score as well. So for your clients that are going to Credit Karma, they're not seeing a FICO credit score. They're seeing this Vantage credit score. And as you can see here, the weightings of information are different. So it's not an apples to apples comparison. It's very much apples to oranges. But on top of that, the way they interpret information is different. When they go to places like Credit Karma, it's going to make suggestions for them to take actions that will help only this score model. It will not affect a FICO score model in the same way. So no matter what model of the FICO score, the base foundation of 35% history, 30% utilization, all of this stays the same. There's just tweaks in the interpretation of this data. But with Vantage, we're starting with a completely different percentage. And then on top of that, interpreting the data differently. Anyone have any questions on the differences of FICO scores models or the difference between Vantage score algorithms and FICO algorithms? Because I'm happy to go into that more.
It's great. Thank you.
Okay. Okay, let's look at the credit myths. So one of the myths that we see, and all of these myths I've based off of speaking with clients who are trying to qualify for mortgages. So these are a lot of the misconceptions that they're coming to the table with as they go to qualify with you. So a lot of times they think checking their credit scores is hurting their scores. So obviously we want to break that down into an inquiry versus a non-inquiry. So when they're checking their own credit scores online using credit monitoring, a lot of times they have a misconception that that's an inquiry. It's not, as you know. But separate from that, if we look at inquiries a little bit further, when you're pulling their credit, that initial inquiry for the mortgage does not affect their score for a full 30 days. That impact is suppressed for 30 days. Most people don't realize that. The other thing that's important to understand is there's a lot of confusion around the shopping around and how long of a time frame they have to shop around and how many inquiries are truly impacting their score. So they have 45 days, and all inquiries within that 45-day time frame for a mortgage only are going to impact their score once. And the inquiry itself is not worth very many points. Usually about 1 to 5 points for the average credit profile. Now, if you have a client who has super limited history, maybe they only have 2 or 3 accounts open on their credit report, it's going to affect their scores more because there's less data to go off of. We talked about this. Closing accounts helps your score. I'm going to kind of skip past that just because we already addressed it. Here's another point of confusion for many individuals around carrying balances on credit cards. There's a lot of information on social media that tells clients how and when to pay credit cards and how much. That is, it's off. It's just incorrect, unfortunately. So a lot of clients think they need to constantly carry a balance month over month on their credit cards, and they're afraid to pay them off in full. The reality is they just need to keep cards active and use them at least once every 3 months. Because one of the little known pieces of information is if they're not using cards at all, then the algorithm starts to look at those cards as not impactful, right? An algorithm wants good, clean data. If it's not used, it becomes bad data. It's stale data. So once a card is not used for 6 months, it's hardly factored into the algorithm at all. So if you have a client who hasn't used their credit cards in a very, very long time, they can see a quick score boost just by using those cards. And they don't need to be carrying balances. We just need to make sure it's reported. So you don't want a client to use a card and then go home and pay it immediately, because then the creditor is never sending that information over to the bureau. There's not an opportunity for that at that point. I think we all here know that income does not impact credit. It's very much just based on debt and the activity around debt and credit. A very, very common misconception that we hear quite a bit from consumers is that paying off a debt removes it from credit. Now, typically we hear this around negative debt, a charged off credit card, a collection account. Often they think once it's paid, it just automatically, it's not on credit anymore. Unfortunately, that is not the case. And even a paid negative account still adversely impacts scores. Now, something helpful to know is something like a charge-off account, even if you can ignore it and still qualify someone without it being paid, if it is paid, they will see a jump in scores. And part of that's coming from that credit utilization category. We have a balance on an account with no extended credit limit. So once it's paid, it can help that overall utilization calculation on the report as a whole. Collection accounts are very, very different. A paid collection does not help the FICO credit score that you use in mortgage lending. Where it does help, and this is why clients get very confused, is that Vantage score on Credit Karma. They're going to see a huge score boost from paying a collection. So they think that money they're spending is really working for them. It's not for a mortgage score, unfortunately. Now, alternatively, if that collection company agrees to delete the account from the credit report with a payment, very, very, very different. That will, of course, help their scores because it's gone. It's as if it never existed. So I think I covered all the points there. Any questions on that? Okay. So I think we've already covered this myth as well. You only have one credit score. You have tons of different credit scores. Oh, I know what I was going to say. The newer models, if your clients are checking like Experian's website for their scores, that's giving them their FICO 8 credit score. That's a different score than what's used in mortgage lending, and they will see a bump in scores from paying off a collection with that model as well. So it becomes extra confusing because most clients don't pay to get mortgage scores because they're not offered for free on any monitoring platform, even through the bureaus. Okay. Does anyone want to dive into collection accounts more and dealing with collection accounts with clients?
Yes.
Yes? Okay, great. Want to make sure before I go into it. All right, so this could be review, but I'm still going to go over it. So collection accounts are confusing for many, many people when it comes to the credit report and how to address them. So the original creditor, I'll use an example. Let's say it's a Macy's credit card. So Macy's charges off that credit card because it goes unpaid. That client now owes the charged off balance of the $500. Macy's decides, we're not going to get this money. So what Macy's does is they sell that debt along with a pool of a whole bunch of, a whole book of debt really, from a whole bunch of consumers. Debt collectors then choose to buy that debt. A lot of times it's similar to an auction format. It's the best comparison I can give. So they're buying the debt for less than what it's worth, and then their whole goal is to collect more than what they bought the debt for. When that third-party debt collector purchases the debt, they can choose to report it on credit. They don't have to, because they are paying each bureau to report, which is why oftentimes you see debt collections not on all 3 bureaus. It costs them money to report. So a lot of times you'll see debt collections on just 1 or 2 credit bureaus, but you can see the bigger debt collectors do report to all 3. And one of the most overlooked pieces, I guess I kind of already talked about this part, but one of the most overlooked pieces when it comes to debt collections is how long can it be on the credit report? It can be on the report 7 years from the delinquency. So a lot of times people get really confused because they'll see the open date on the credit report for the collection be like 2 years after the debt went past due with Macy's. Well, it can't report for 7 years from the date it was purchased by the debt collector. It's 7 years from when Macy's bought it. The reason, I'm not really following the slides very well, so that's okay. But the reason why they often do that, they misreport, is they want it on the credit report longer than it should be. I mean, to put it plainly, keeping something on the credit report means they're more likely to pay, right? Because you're more likely, it's a coercion tactic, right? If it's on credit, a consumer is more likely to pay because they want to improve their credit scores. There's also statute of limitations for judgments or any sort of legal action that's very different from the statute of limitations for the credit reporting. So why I bring that up is sometimes you will see a debt collection not on the credit report, but then you don't have a clean title. You find a judgment on title. Well, the judgments themselves vary by state for how long that debt collector has, or even that creditor has, to pursue legal action after the consumer. And then that judgment is valid for longer than that debt can report on credit. So sometimes you can be surprised with a debt not being on the credit report, but then still having a judgment that has to be taken care of. So, make sense? Okay. So a single collection can impact the credit score by 100 points or more. Now, where you see variation in that point value impact is going to be on the structure of the report itself. So if you have someone that has a lot of negative history, when they get a new collection, it's worth less points because the algorithm is already considering them as a high credit risk. Whereas if you have somebody with no negative history and they suddenly get a Comcast collection, which is a really common thing we see, or nowadays the new trend is a insurance collection from Allstate, Geico, or Progressive. We're seeing a ton of that right now. That can drop their scores 100 points or more. So you had someone at an 800 that's now at a 700 or even sometimes 680. It's huge impact. And Kimberly, what were you going to say?
Oh, no, sorry. I wasn't.
Oh, okay. Didn't know if you had a question. But when you see that giant drop in credit score, a lot of times someone that consumer instantly calls that collection agency and pays. And they're like, oh, good, thank goodness, now my score is going to recover. And then they go to you as a lender and they're like, yeah, I had a collection, but it's all taken care of. Now my score will be fine. You pull credit and their score is not fixed. Well, that's just because of that mortgage algorithm. It's functioning differently. And then they're super confused because they're looking at Credit Karma or even their FICO 8 score on Experian's website. And they're like, what do you mean? It looks better. So if a client has that happen, you have a couple of options. One, they can pay, but we want to go about it strategically. Instead of just calling that debt collector and paying, they need to negotiate a payment in exchange for them deleting the account. And they want to get that in writing from the debt collector before they make that payment. Because unfortunately, people lie over the phone. And then they're SOL if they pay it. And they don't remove it, right? Also, you want that letter. That's going to help you, of course, if you're trying to do like a rapid rescore or something. But separate from that, the other option is they can choose to fight it, right? They can choose to dispute the collection account. And here we go. This is where I'm at. I'm just talking. I'm not even looking at the slides, so I apologize. So when they fight a debt collection, it's one of the highest likelihoods of this is a poor sentence, but the point will come across. Debt collections are the easiest thing to get off a credit report. That's what I'm trying to say, as compared to any other derogatory information. The reason behind this is because debt collections have a higher burden of proof, and they really have more laws and regulations they have to abide by as a third party, as compared to that original creditor. So when we're talking about a debt that has passed multiple hands, the likelihood of that debt collector having the original contract, having the payment history, proving the amount they owe is low. They're buying a whole bunch of consumers' debt all at once. They're not necessarily saying, hey, can you make sure you give me every piece of information I need to prove that this consumer owes the debt? Because most people don't even know to ask for that, right? If you're a client, you're freaking out because your score just dropped, you just got a new collection, and all you're trying to do is pay. You're not thinking rationally, you're thinking in survival mode, and you're just trying to deal with things. But most often we find, and it's not a rarity, it's the commonality, that they don't have the proof that they're obligated under the law to have in order to report the debt or collect on the debt, which means as soon as that client disputes that debt, as long as they do it the right way, they can get it off of the credit report and absolve themselves from owing it because they don't have that proper documentation. Okay. And then obviously, if it's a super, super, super old debt and it shouldn't be on the report, that's a whole nother issue, right? If it's over 7 years old and it's reporting, that's a legal violation as well. So there's two ways to get it off: disputing or asking for a payment in exchange for deleting it from the credit report.
Ivory, I have a question.
Yeah.
So I've had clients, oddly enough, got something removed, and then a couple months later, it popped back up again.
And did it pop back up with a new debt collection company?
It's been a while since that's happened, but I've had
okay.
clients just explain. They're like, I don't know what happened. I thought we got this removed, and then all of a sudden it's reporting again, or who knows? I mean, there's been so many different various reasons.
Sure. So most often we see that happen. Here's two different ways it can happen. The first way is they dispute the account. During the dispute process, it's suppressed from reporting, or during the investigation process, it's suppressed from reporting. So it's just temporarily not showing up while an investigation is being conducted by either the bureau or the debt collector. So that's temporary. If then after the investigation concludes and they determine it's valid, which it's not always valid, I'm just going to say that, but let's say they determine it's valid, then they'll re-add it back to the credit report. So that's one way that could happen. It was never truly removed. The second way it can happen is it's disputed. The debt collector is like, shoot, we're not going to be able to collect this debt. So they hurry and sell it to someone else.
Okay.
Because they want to make some money off of it. Now, it can only be sold so many times before it erodes in value to where nobody wants to buy the debt. But it can be sold multiple times. It's not overly common, but it does happen. It really does happen, unfortunately. So that may be what happened there. And then you just have to follow that same process again of disputing it for the validity. You have there's a lot of legal protections for debts, debt collections, and other issues on the credit report that most people just don't know exist. So I truly would say if someone has a collection that pops up and they don't know how to handle it, they should seek help before panicking is really the most important thing. Obviously, it's something we can help with. There's several other companies out there that do the same thing, or they can really do their due diligence and do a lot of digging online. They just have to be really careful with what they find online because there is unfortunately a lot of incorrect information out there. But in my opinion, no debt collection should be paid right away. It should always be disputed first. Now, if they're in a massive rush, okay, pay for delete's probably the only option. Now, to deviate from that slightly, we also have medical collections. So medical collections, when they are paid, will be removed from a credit report automatically. That's the only type of debt that's automatically removed. And that's based on a law change a couple years back now. So those ones you're safe to pay. Obviously, you can ignore those for qualifying somebody, but it still affects scores. So I think sometimes I see loan officers overlook the value of having a client pay those off. because you can see a nice score bump if they're gone. They affect scores the same way as any other collection. Now, for anyone here in Washington State, medical collections cannot appear on a credit report for residents of Washington State. We'll see how many other states start following suit, but for now, that's only true in Washington. So, yeah. Any other questions on debt collections? Okay. Some of these I'm going to skip past because I actually already talked about it. Sorry, bear with me. Oh, okay. Yeah, we can talk about this. Okay. Let's talk about this real quick. I'm going to skip through here. Sorry, bear with me. Don't look if it's too painful to see the screen flashing that much. I told you this was very long. Here we go. So one of the things that most clients don't realize, and even loan officers, is how many errors exist on credit reports. And I kind of touched on that earlier. So when you're pulling a lender report, they look pretty, every lender report's slightly different, but they look very similar to this, right? When we're looking at credit reports, there are ways to get people's scores up who have a ton of negative information. You have those clients that are in the 400s, 500s, even 600s, and you want them to have a much higher credit score. Yet you're like, okay, well, what can we do about the charge-offs, the late payments, the collection accounts? We talked about collections a little bit already. Well, the key is understanding that all credit reports have some sort of errors. Now, it's whether those errors are valuable or not, because some are not, right? But the law says, the Fair Credit Reporting Act says, your report has to be accurate and complete. So what we are looking for on credit reports is inaccurate data, inconsistencies, so differences between the three bureaus, right? If the three bureaus don't match in their data, it can't be accurate. Information that's too old, so a collection, for example, it's over 7 years, it shouldn't be on the report, or a charge-off over 7 years shouldn't be on the report, and then missing information. So it is possible to remove valid negative accounts. What I mean by that is someone was past due. They did have a charge-off. The way that information comes off the report, the way the accounts get deleted or the late marks get removed is because of issues like this. The bureaus have to follow the law. And if we have, in this case, look, we have a charge-off. This is a snapshot from annualcreditreport.com. That's what we use for disputing because it's the official reports. Excuse me. It gives more data than what you see on a lender report like this, right? You're limited in the data. So this person's history it's largely blank, right? We're missing all of the positive history. And then all of a sudden we go from no data to 60, 90, 90, 150, and then randomly charged off in April and May. So we have missing data. We have inaccuracies. You can't go from no data to 60 days, right? So what happens is a consumer themselves, or they can hire a company like us, can dispute this information. And the result is the bureau either needs to fix it or delete that account from the credit report. Most often the bureaus delete it because it's a lot easier to delete it than figure out what needs to be corrected and correct it. Okay, so this is just another example. In this scenario, we saw a 30-day delinquency, then a repossession and a charge-off. And this is valid. This is accurate. You can go from 30 days to a repossession. An auto lender can start repossessing as short as 15 days past due, which is crazy, but it's possible. And then the remaining balance after the vehicle is sold in auction can be charged off. So all this makes sense. But then when we look at the other data fields, we find that these balances don't line up with what happened. So 2023 is when it was 30 days delinquent and then repossessed and then charged off. They put these on the wrong spot. So now we have material inaccuracies that can be disputed. And in both these cases, we actually saw these accounts deleted from the credit reports. Why is that important? I think is obvious, because it means now you have a client that can have a higher credit score and can qualify more quickly than waiting 7 years for it all to come off their credit report, all because the bureaus don't care about having clean and accurate data. They're in it for the profit. And it's easier for them to get by with these errors and then just remove it than it is to have a good process, unfortunately. So a lot of the things that are common on a client's credit report is just the inconsistencies across the bureaus. You can't really see that on a tri-merge report because everything's merged. Outdated account statuses. Sometimes you have clients that have charged off accounts and they tell you, oh, I'm in a payment plan on that. But that creditor didn't update the balance until the whole thing was paid off. They have to be reducing that balance over time, and often they don't. That goes into wrong balances, wrong credit limits, accounts that they don't belong to the client. So we do see fraudulent accounts, of course. Sometimes we see duplicate entries of loans. There are a couple creditors out there that we commonly see the same account twice on a credit report that's charged off. That's hitting that client twice. Or we'll see, let's go back to our Macy's example. We see that Macy's credit card on the credit report and the collection, perfectly valid, but we see the balance showing up on Macy's and on the collection. They both don't own the balance anymore. Macy's sold the debt to the debt collector. Only the debt collector can have the balance. And then re-aging we talked about, when the debt collector changes the age to keep it on the credit report longer, right? They use that open date based on when they bought the debt. So those are some common things we see. So we have a lot of plans for clients. I think that part we usually keep for more when we're showing this to consumers. But does anyone have any questions for me on what else can be done to help improve scores? Because I can go back in time and we can look at other pieces.
So I have a client that I'm trying to do a rescore on, and analytics said, we can go on to the credit bureau that we pull from, and it said pay off one of the collections, and get a letter, which he did. But the other one was to, charge a $10 balance, but he only has like a Chime account, but as soon as he charges it, it pays off. So it doesn't.
Oh no.
So, and I don't know anything about that Chime account, but
yeah.
Odd.
Yeah, Chime account is kind of it's like a cross between a debit card and a credit card, because they basically filter paying things through the Chime account.
Yeah.
It's like a middleman. So your tool is not understanding that Chime doesn't function like a typical credit card.
Okay.
And that's really the problem. So there's this sweet spot on credit cards between 1% and 9% where you get a score bump if you have a balance between 1% and 9%. So under 10% is the best way to put it. And I think that's what the algorithm is kind of shooting for when it's giving you that information. But what you can look at, and I wish I would have shown an example, is the very, very top of their credit report. It will have like the top 5 factors impacting scores.
Mm-hmm.
And a lot of times you can fill in the gaps there. And it's just about, and you can, if you want, like if you get your client's approval, I can look at the report and tell you what they need. I'm so sorry, I'm going through a million screens again. But basically, if you go to the top there and it says what the most impactful top 5 factors are that are pulling scores down, you can then use that to see where do we need to fill in the blanks.
Right.
Where can we optimize these pieces? He may just need to open another credit card. It could be that simple.
Yeah, and I think that's probably the case, because when I looked at, he has like only these 2 accounts that are like, another one's like Chime, and then like 4 collections. He has nothing else. So he doesn't have any credit, and that's kind of his issue. And so
well, that's an easy fix.
Yeah, exactly.
I mean, basically for him, I would also have him do rent reporting. And like, okay, so the classic FICO score operates very differently, but it doesn't consider rent reporting or self-reporting in the same capacity as the new algorithms do, but it still makes his profile more well-rounded, which will still help the classic FICO score. So I would probably have him do, how much time does he have?
Yeah, I gotta talk to him, but I'll talk to you offline. I think your information is on the invite, so I'll get connected with you. We can chat.
Yeah. Yeah, that's an easy fix. What other questions does anyone have?
I have one. My biggest frustration is somebody out there telling people to go get payday loans to improve their credit.
Ah,
I know.
that's horrible. We definitely don't want that. Yeah, and that's honestly, this industry I'm in is kind of horrible. There's a lot of predatory things that are happening on social media where people are trying to make a quick buck off of other people. And so they're getting affiliate income from these sources. And that might be what's happening there. But yeah, no, a payday loan doesn't help. Alternatively, what they could do is like a self account or a kickoff account. I like self better because it reports to all 3 bureaus. But the self account is a savings account that reports like a loan on credit. That's a safe alternative to help build credit. And then we use them a lot to help people with saving for a down payment as well. So by the end of that term, they get their money back, and it's 1%, 1.5% interest. So it's not a ton of interest, but it allows them to build that loan history and help the credit mix and create payment history. And it's not a payday loan. So
Amen. That's a good idea.
yeah. What other questions does anyone have? None? Okay. Well, that's it for today then, if there are no other questions. But yeah, feel free to reach out to me. I'm always happy to look at scenarios with your clients and just tell you what to do. We love giving free advice. The more people we can help qualify for homes, the better. Sometimes your clients may need our services. Sometimes they don't. Sometimes it's just a nice, quick, like, hey, tell them to do these couple things, and we're going to see a nice jump in scores. And it's nice and easy. And next year, whenever we do transition to the new models, I'm sure we're going to do another class on those models and how they operate different from what I shared today. So you know how to advise then.
Perfect. This was great.